Welcome, everybody. This is Tracey Velt, the Senior Director of Data and Content, filling in for Sarah Wheeler this week on HousingWire Daily. And today's guest is Logan Mohtashami. He will answer the question, is Trump looking to fire Jerome Powell? We also talk about the mortgage rates and market volatility. So enjoy the podcast. All right, our time is coming to an end, Logan. This is the last
I know,
one.
so much fun. And I feel like I was free. Sarah wasn't here to boss me around and tell me what to do and stop the editing, take that out. And so I enjoy not only the podcast, but the edits, everything. I love it. So.
Oh, well, until we meet again, let's get into this one. So I want to start with the Fed. And, Trump's pressure on Jerome Powell to lower mortgage rates. Tell me a little bit about what's going on there and what you think is next.
So there was a lot more verbiage and discussion on social media this week that because of the Supreme Court rulings, that the talk was President Trump actually asked the Supreme Court if he could fire the head of agencies. And really everyone's just seeing, does that mean he's going to try to fire Jerome Powell? Some people who, this is not my legal stuff, it's not my wheelhouse, but some people are saying the Fed would be probably blocked off, and other people say, no, the Supreme Court will actually go with him. In any case, that's brought up again. So I'm going to have to eventually address this if it does happen. We've been having a very big theme in our work that he's going to go after Powell at some point, because there's three things that President Trump needs to do this trade war right. And we highlighted this back in November. We talk about it all the time in many podcasts and articles. He needs the US dollar to go lower, because the dollar being too strong doesn't do him any good. That's happened. The dollar's under 100. So he got that. Oil prices are lower. People are worried about expected growth, not only around here, but around the world. So oil prices are good. Mortgage rates were heading lower. Purchase application data was positive. Year to date, year over year, all of our weekly contract data, by the time Monday comes out, we'll know if that is still the case. But now the 10-year yield is reversed. Now the 10-year yield to me is still in its range that I was looking for. So it's not like the level itself is detrimental to me, but people were heading toward, hey, home sales are growing, everything. And all of a sudden, because of the market chaos, things have shifted. And we're talking, these are very, very violent moves. So going out in the future, let's just assume the president doesn't do kind of any deals anytime soon and economic growth gets hit. Does he try to fire Jerome Powell and maybe fire a few Fed presidents that, doesn't see eye to eye with him, get people in there that will see more eye to eye, and have them cut the Fed funds rate or do whatever they can to keep the 10-year yield lower, because that's their thing. That's the marketing line. They were highlighting that when the 10-year yield got below 4%. And this is why I caution everybody, boy, if it wasn't for the stock sell-off, we really wouldn't be here. But this is a legitimate question going out in the future. Now, if we do a few deals and things calm down a bit and everything gets kind of back to normal, there'll probably be less appetite to do something like that. But I've been saying that there's going to be a fight, and this is getting more and more discussions. We'll see how it plays out for the rest of the year.
Do you think the fight is more personal or more strategic, where the Fed has a different way of going about this than what Trump or his cabinet feels is the right way to do it?
So this goes into this question. This morning, we're talking on Friday morning, New York Fed President Williams came out and said, I expect inflation to rise to 3.5% to 4%. I expect GDP growth to go down to 1%. And I expect the unemployment rate go up to 4.5% and 5%. And then he said, monetary policy is fine because inflation expectations are anchored. If I was Trump, I'm pulling my hair out, like what? With everything he said there, you would probably want the Fed to go, well, we are going to be a little bit more dovish. No, he held the line. There's other Fed presidents that have kind of said the same thing the last few days, that they're kind of holding on. That's why I wrote that article, that until you really see like job losses aggressively, the 2 rate cuts that were priced in was going to be priced in anyway, right? But the market is going one way. They're saying more rate cuts, and now other people are saying we're anchored. So the fact that the Federal Reserve has raised this inflation expectations, raised their inflation targets, means that they're more prone to standing still or doing what was originally expected before the trade war, which is at most 2 rate cuts. But then it gets into the point, well, if there's jobs lost, what happens? I'm sure President Trump doesn't want to even get to that point, that we have that discussion. So this is a White House with their view on what they want the economy to be, and the Federal Reserve says, okay, we just have a dual mandate. We want maximum employment and price stability. The tariff thing is your call, not ours. You did this, so we are just doing our job. So there's where the conflict is going to happen, and the president doesn't like to be told that, I'm going to do this way. So again, if there's deals done and things go back to normal, there will probably be less appetite for this. But I thought if the 10-year yield had gone below 4%, which I wouldn't have agreed with the economic data, but if it did, the White House would probably be very happy because they have the 3 things they wanted. These are the 3 things we've highlighted since the end of last year: a lower dollar, lower energy prices, and lower 10-year yield. Because in their minds, they think the consumer says, gas prices are this, people are buying homes again, okay, and the dollar is getting weaker, we can export stuff. So 2 out of the 3, but the big one, the 10-year yield, has reversed on them, so they didn't get that one. But that's where the fight gets interesting. If the 10-year yield had been lower, I would not be talking about the subject today. I don't think Trump would have cared one way or another. But since things are reversed and things have calmed down, and he even mentioned that, I did the 90-day pause because people are getting nervous. So it'll be interesting conversation if things get worse and bond yields don't respond.
Yeah, I mean, it seems to me like something needs to break with China for Wall Street to be happier at this point.
With what's happening with the stock market, we have to remember this is just from what I've heard. Everybody was hippie-ki-yay, markets are up. Trump's people are saying business investments up, everybody's enthusiasm, it's going to be deregulation, markets are going to do good. So the markets were very priced for perfection, if you believe in that concept or theory. However, Godzilla tariffs were not part of it. And from what I hear, not even half the White House staff or workers knew that was coming. So I think this is the problem. It would probably be better for President Trump to get rid of Peter Navarro. Peter Navarro just has such a warped view on trade that he doesn't realize that Wall Street and the bond markets don't care who he is. And I think Navarro and Lutman, these guys basically did it. So if it is true that half the economic team didn't know about that stuff, then you could imagine Wall Street was shocked. The global markets were shocked. So all of a sudden, whoa, do we have to price in a recession now? Okay, that's a whole different ballgame. So markets sold off, liquidation, hedge funds, all this market drama is happening. Eventually, it'll calm itself down. I think right before I got onto this podcast, the 10-year yield was at 4.44. So we're not at a level that I see to be obscene. It's just the speed. And when you have speed and you have targets that you could get mad at and stuff, all this chaos happens. For someone like me, I love it. This is my cup of tea. But for everyone else, the consumers, the Michigan Consumer Index has just imploded. People think inflation's going up. People think that they're going to lose their jobs. The confidence index is completely warped. So eventually this will pass. You can't do this for 4 years. Something will be done. But I think the chaos speed, the rate of change of equities and bonds and everything has got everyone worked up a little bit more, even though the total levels of where the 10-year yield is right now isn't like very extreme. I mean, it's not even in my peak forecast call for this year.
Yeah, I think perception is reality for consumers. So what they, the chaos scares them, and they immediately go negative, or concerned.
Yeah, it is interesting. I find the survey indexes completely useless. I
Mm-hmm.
mean, there's just we had confidence index basically at the low levels of COVID with the economy growing at 3% and
Yeah,
retail sales growing.
yeah.
So I'm very skeptical of surveys, but because of what happened with the stock market and the bond market,
Mm-hmm.
everyone sees it, right? Whatever people think about equities, when they see stocks falling, they don't think anything good. You know, if stocks weren't falling, bond yields fell, mortgage rates fell, energy prices fell. Oh my God, the consumer would be like, great. But it's one of these things where tariffs are something that people just aren't used to, or we don't talk about it a lot. It's just when Trump's here, that's his thing. And there's a lot of kind of confusion. Both inflation reports this week were both came in lower than estimates. The CPI inflation has a 2 handle, the PPI inflation fell. So it's not like inflation is breaking out, but now you're starting to get Fed presidents raising their inflation targets again. And we've talked about this in other podcasts. They're probably going to raise their inflation targets and unemployment rate targets again. And Fed President Williams of the New York Fed has already done that in a more aggressive fashion than what the general Fed presidents have.
So let's talk about the market stress just on mortgage rates. I saw some on Diego's LinkedIn, someone was expecting like 8% rates, and there's all this speculation around mortgage rates right now. So talk to me a little bit about that.
So we're not getting 8% rates because the spreads are not as bad as 2023. We would have never had 8% mortgage rates if the Silicon Valley banking crisis never happened. The 10-year yield Friday morning at the peak level was at 458. Mortgage rates 710. The spreads got a little bit worse today, but we're about 70 basis points away from kind of the worst levels of the spreads before. So we're 8% isn't the fact. 7.25 was my peak forecast for this year, but the spreads have been getting worse during market stress. So all year long, when the bond yields go up, the spreads get better. It limits the damage. So it's a more calm marketplace. But this is why the faster you get some resolution, the better. The spreads could act normal and everything could kind of somewhat come back to normal because the spreads have been a better story. I mean, we would not have had the positive year-to-date positive growth in purchase application data, which Ivy Zellman was even surprised. I was surprised, but we'll talk about that a little later. But the spreads compressing is a positive, and here today's case is a good one. We would be near 8% today if we had the worst levels of the spreads in 2023. So the Fed funds rate is lower than what it was, so that's a positive in that sense. And it's going to take a lot more to get the 10-year yield to really thrust up higher than 470. That's why 8% rates are a little bit more difficult now. But as this happens, as bond yields go up, the Federal Reserve looks at that as financial conditions getting tighter in their eyes. So they do less, or they talk less hawkish when that happens. But President Trump had 2 of the 3 things he wanted, but the bond market went against him. If it wasn't the case, it'd really be interesting if the 10-year yield was at 380 and mortgage rates were near 6%. I don't know how much he would budge on the trade war stuff because he's got these 3 things. So again, we'll take it one day at a time. Who knows? By the time this podcast might happen, everything could change. We just don't know. We say this during podcasts now. 10 minutes from now, I could get off. I mean, last time when we talked in our podcast, as soon as I got off, I went up, the 90-day thing. So it's the speed of everything. It's just 1 or 2 headlines. And when 1 or 2 headlines could change everything, you're just sitting there waiting for that big variable to come in.
Yeah, I think that's also the kind of scary part for consumers and home buyers and even sellers is, they went from an administration that really there was none of this chaos, not a lot of things really happening to all of a sudden just total every day there's something new, every hour there's something new. So it's just a dramatic shift from administration to administration. What is your prediction right now, just on the housing market in general? Have you changed from your forecast?
I was going to be too low with my home sales because I would have never, ever said all of our positive forward-looking data lines are year-to-year growth in April with rates still elevated. I would have taken that bet if I knew mortgage rates were going from 6.64 down to 6%. I'd take that bet every single time. That's what the data's shown. But to have this happen, like, I'm excited about the housing market because if I'm seeing this now, that means whenever you get to that next level of rates, that means you really have that backup pent up demand there. That even with elevated rates, you could still get some growth. Imagine just a hypothetical. Imagine if mortgage rates were 4.875 to 5.75 for a year. We're growing sales everywhere. The builders existing, we don't have policy for that. So that's why I don't go there. But you can clearly see the builders were able to keep sales at 2019 levels because they pay down rates. 2019 existing home sales from here is an extra 1 million, basically. So there's something there that you can see. It's just that rate aspect, and to have the data show year over year growth with rates here is just a testament that we're just at such low levels. And every year more people will get jobs, and every year you have dual household incomes. And even with record home prices grow, all-time highs in prices, mortgage rates are elevated compared to the last decade, property taxes, insurance, demand was growing this year. So this something for everyone to remember. If that mortgage rates go lower towards 6%, like it did the last few times, and sales grow, you got to go with it. Mm-hmm. If the forward demand data goes positive, you got to go with it. I'm still seeing people out there who are just simply ignoring these things and think that home sales are crashing. They're not, right? So follow people that track live weekly data and let them tell you what's really happening.
Yeah, I know in my neighborhood, there's low inventory houses are turning over, in less than a week, easily, multiple offers still. And I'm in Florida.
Yeah, I mean, again, when I look at the total active inventory, if I use the NAR data, and we stressed this at the webinar today with Ivy and Dale, I said 2 to 2.5 million is the norm since the 1980s. We had one deviation breakout in 2007 where the inventory got to 4 million. We had one really big deviation breakdown, where we got under 1 million. But we're at the last existing home sales report was 1.24 million. That would be record all-time lows pre-COVID. We're working our way back. I'm actually not a low inventory person. I look at inventory a little bit different than everybody. Ivy and I had a little debate on this topic. I actually think if you get to 2019 inventory levels, I'm fine. I'm never going to usher the word low inventory ever again because you have a functioning market. The days on market are above 30 days. You don't have too many multiple bids. Those things were common in the last decade. We just got to a really, really bad place right when COVID broke out. It was the worst timing ever that the housing market authentically broke out right before COVID hit. And we had pre-cycle highs in demand, but then inventory crashed in 2020. Like literally, we didn't have any seasonal curve. And I'm like, oh boy, we need higher rates because it just got to such a low level. I mean, just for our Altos data, 240,000 single family homes in March of 2022. With a country of our size and our population, our workforce, that was savagely unhealthy. So I love this year because I'm getting balance. But again, for sales to grow, we have the framework. I would feel much better about the housing market when all the inventory level is back to 2019. And then I am zip. You'll never hear me talk about low inventory ever again.
So you did do a webinar with Ivy and Dale. What was like maybe your greatest takeaway from it?
To me, obviously the discussion, a lot of it revolved around affordability. And I have a kind of a different take. I always go, what does affordability look like? Like, what's an affordable house? And I always say that it's always the person's income and where rates are. I look at it in this way. We have record price growth in a very short amount of time, and now that's cooling off. We had elevated mortgage rates that are somewhat cooling down. And even with property taxes and insurance, we have near 5 million total home sales. In the previous decade, the decade peak total home sales, new and existing, was around 6 million. So even with the second worst affordability period in history, we're missing just 1 million mortgage buyers. Millennials still were the biggest home buyers until last year. The boomers took them out, but they're still a very big portion of the workforce. I just simply believe the data shows if rates could go down, we're growing sales. Or the notion that home sales are just about to have another stage lowered. No, that's history hasn't shown that, because there's the group of home buyers. And I think this is one thing where Ivy and I might disagree. Ivy Zellman was talking about, the median dual income is $82,000. Well, how do we get 5 million home sales with 62% plus of the buyer dual household incomes? Home buyers, 2/3 of the economy, dual household income, they make more than the median. There's 1/3 of the society that are lifelong renters, unless they're part of a dual household income. So the home buyer aspect, and if you look at aggregate data going back decades, the middle class actually shrunk because we have more people making 100,000 than every time before. It's not that, the wages were less. And if you put that together, this is how you explain near 5 million total home sales, even with how crazy things have been, even this year. So I think going out in the future, I think another thing Ivy and I talked about, Ivy said that the consumer confidence is really getting hit and people are going to pull back. Okay. And Sarah and I have been talking about that because Sarah says that as well. And I go, well, then purchase application data would decline, right? It hasn't throughout this whole thing. Now, the 10-year yield going up, mortgage rates going up, that impacts the purchase application data. But I've followed this stuff for the last 14 years. And I can tell you, we've had a lot of drama in the last decade. We had COVID, right? Forget about it. Stocks are falling. People were like dying and, oh, my rates are 3%. Let's go get a house. So I'm always going to say the 10-year yield to me just moves with housing data much more fluently than confidence data, because the confidence data was terrible, October, November, December of last year going into January, and the forward-looking data got better as rates fell. So it's that equilibrium trick about how do you look at consumer data? How do you look at actual hard data? And the Federal Reserve presidents will tell you that, well, the hard data still looks fine. The sentiments are terrible. Like the Michigan Consumer Index is the worst reports I've ever seen in my life the last 2 months. Like if you saw it, it's just like you're basically thinking a meteorite's going to come and destroy Earth. But you get a little bit of closure on some of the trade wars. You get a little compression, less volatility. We were there. We were going there. So that's why I'm excited. I just hope that the new listings data could still grow. We're starting to get to the seasonal. What you don't want is what you saw in 2022. All of a sudden, people just pull the plug and go, I'm not listing in this. I don't know. That's what you don't want to see, is people not list their homes like we saw in 2022 and 2023 in the second half of 2022. So that's another thing I'm going to keep an eye on, is that I don't want to see new listings decline. I want to see inventory growth. And everything becomes a balanced market, and you let the marketplace work how it is. And those are some of the things that we discussed in that webinar.
Well, Logan, I fear I've been way too easy on you this week. I can't wait for Sarah to get back and stick
I know.
it to you again.
I'm thinking, I was like, this is so chill. I love it,
Oh, but thanks so much for everything. Appreciate it.
My pleasure.